Right now, there is a number circulating in financial media that has people genuinely frightened. 77%. As in a 77% collapse in the S&P 500. And it is attached to one man's model, one man's forecast, and one very dramatic headline. And here is my problem with that conversation. It is the wrong conversation. Not because the number is necessarily wrong, but because everyone is so focused on how far the market could fall that nobody is stopping to ask the more important question. The question that actually tells you what is happening structurally and why this moment is different from every correction, every crash, every this time it's different moment of the last 3 decades. The question is not if the market reverts. The question is why the math that kept it elevated for 34 years just broke. Here is what I mean. If you look at 126 years of valuation data, not just the last bull run, not just post-2008, but the full historical record, the market has spent the overwhelming majority of that time operating within a defined band, a mean, a gravitational center that it always eventually returned to. Then, starting around 1991, something changed. The market didn't just rise, it decoupled. It entered what I can only describe as an anomaly, a 34-year period of artificial elevation that looked from the inside like a new normal. It was not a new normal, it was a glitch. And the glitch had 3 very specific causes, 3 invisible gears that ran in the background, keeping the machine elevated against the natural pull of 126 years of arithmetic. Today I'm going to show you exactly what those 3 gears are, and more importantly, I am going to show you why, for the first time in history, all 3 are now reversing at the same time. That is not opinion. That is mechanics. Let's get into it. Let's start with the gear that almost nobody talks about, because it doesn't have a ticker symbol, it doesn't show up on an earnings call, and it didn't happen on Wall Street. It happened in Washington in 2006. That year, Congress passed the Pension Protection Act. And buried inside that legislation was a provision that would quietly become one of the most powerful forces in the history of financial markets. It made automatic enrollment in employer-sponsored retirement plans, your 401k, your 403b, the default, not an option. The default. What that means in practice is this. Every 2 weeks across tens of millions of American paychecks, money moves into the market. Not because those people analyzed a balance sheet, not because they looked at a valuation model and decided equities were attractively priced. They didn't make a decision at all. The decision was made for them by law, and the money flows automatically into index funds and target date funds, which themselves flow automatically into stocks. This is what I call passive inelasticity. In a functioning traditional market, price acts as a signal. When stocks get expensive, rational investors pull back. They rotate. They wait. The price corrects because the human beings behind the capital exercise judgment. That is the self-regulating mechanism that kept markets tethered to reality for most of that 126-year history. Now think about what passive inelasticity does to that mechanism. Imagine a stadium that holds 100,000 people. And every single day, regardless of what is happening on the field, regardless of the score, the weather, the quality of the game, 100,000 people are legally required to walk through the turnstile. They don't choose to come. They are enrolled. The stadium fills every day. And the only exit is a single door in the back that for 34 years almost nobody used. That is the structure of this market. Today, approximately 60% of all assets under management in the United States are passively managed. 60%. That means the majority of capital flowing into equities is not asking whether stocks are cheap or expensive. It is not asking anything. It is simply flowing. by payroll cycle, by algorithm, by legal mandate. And here is where it gets structurally dangerous. In a normal market, when a stock gets overpriced, humans stop buying. The price stalls, it corrects. The market finds equilibrium. But in this market, the market that has existed since 2006, the law requires the algorithm to keep buying. Apple at 20 times earnings, Apple at 30 times earnings, Apple at 35 times earnings. The 401k contribution hits on the 1st and the 15th, and the index fund buys Apple every time. That is gear one. It is not investing. It is not price discovery. It is a government-mandated inflow that has been running, uninterrupted, for nearly 2 decades, mechanically suppressing volatility, mechanically inflating valuations, and mechanically convincing an entire generation of investors that markets only go up over time because for them, structurally, they did. The question now is not whether that flow continues forever. And the question is, what happens to the price of a stadium when people start finding the back door? Now, Gear 1 explains why money kept flowing in, but that alone doesn't explain why the market was so remarkably resistant to sustained downturns for 15 years. Why every dip was bought. Why every correction was short. Why the phrase "buy the dip" stopped being a strategy and started being a reflex. That stability had a second gear, and this one came not from Washington, but from the balance sheets of the largest companies in the world. It came from buybacks. Here is the mechanics of how this worked. When a company generates more cash than it knows what to do with, more than it needs for operations, more than it wants to put into new factories or new hires, it has essentially 2 options. It can pay a dividend, or it can buy back its own shares. And for the last 15 years, the largest companies in America chose buybacks, aggressively and consistently, to a degree that has no historical precedent. Between 2010 and 2024, S&P 500 companies spent, collectively, over $9 trillion buying their own stock. Think about what that does to a market mechanically. When a company buys back its shares, it reduces the number of shares in circulation. Fewer shares means each remaining share represents a larger piece of the same earnings. Earnings per share goes up, even if the underlying business hasn't grown. The stock price rises. And when the market drops, and those same companies are sitting on mountains of cash, they accelerate the buybacks, hoovering up their own shares at a discount, putting a floor under the price. This is what I mean by the safety net. It wasn't a conspiracy. It wasn't manipulation in the legal sense. It was rational corporate behavior that happened to create a structural bid, a buyer of last resort that would show up reliably every time the market started to crack. The Magnificent Seven were the engine of this. Apple alone has repurchased over $700 billion of its own stock over the last decade. Microsoft, Google, Meta, the same pattern. Cash machines running at full capacity, recycling profits back into their own share prices, quarter after quarter. And then something happened. The AI arms race started. And it didn't start slowly. In 2024 and into 2025, the capital expenditure commitments from the Mag 7 reached a scale that is genuinely difficult to process. We are talking about $650 billion in AI infrastructure spending, data centers, power infrastructure, and most visibly, chips. NVIDIA H100s, GB200s, rack after rack after rack, at prices that would make a defense contractor blush. And that capital has to come from somewhere. The same balance sheets that were buying back stock are now being redirected. Not entirely. These are still enormously profitable businesses. But the growth of buybacks has flatlined. The incremental dollar that used to go toward reducing share count is now going toward a GPU cluster in Virginia or a data center in Iowa. And that distinction matters enormously. Because the safety net was never about the absolute level of buybacks. It was about the directionality. It was about the market knowing and pricing in that when things got ugly, the largest and most cash-rich companies in the world would step in as buyers. That expectation alone was stabilizing. It shaped how institutional investors behaved during drawdowns. It shaped how algorithms were tuned. It shaped the entire risk calculus of the post-2010 market. Now that calculus is changing. The buyer of last resort has not disappeared entirely, but it has a competing priority now, and that priority is an existential technology race where coming in second place means irrelevance. These companies are not going to slow down AI spending to defend their stock price. The incentive structure doesn't work that way, so what you are left with is a market that, for 15 years, that had a shock absorber built into its foundation, and that shock absorber is now being quietly cannibalized by the most capital-intensive technology build-out in corporate history. That is Gear 2. The buyer of last resort has left the building. It went to go buy H100s. So we have a mandated inflow that is becoming inelastic to price. We have a corporate safety net that is being cannibalized by a technology arms race. And now we get to the third gear, the one that is the slowest moving, the most inevitable, and in many ways the most underestimated force in this entire conversation: demographics. I want to start with a number, 30%. That is the approximate share of all US equities currently owned by Americans over the age of 70. Nearly a third of the entire stock market sits on the balance sheets of people who are, statistically, in the final chapter of their wealth accumulation journey. Now layer on top of that a second number, 71. That is the approximate median age of the baby boomer generation right now in 2026. The largest, wealthiest, and most market-exposed generation in American history has just crossed the threshold that changes everything. Because it's 73, and this is where the mechanics get brutally precise, the IRS requires you to start selling. This is the required minimum distribution, the RMD, and it is the mirror image of Gear 1. Remember how the Pension Protection Act created a mandated inflow, money that moved into the market by law, not by choice? The RMD is the mandatory outflow. Once you hit the RMD age, the federal government requires you to withdraw a calculated percentage of your retirement accounts every single year. Now, whether you want to or not, whether the market is up or down, whether your financial advisor thinks it's a good time or not, you must sell, by law, and you must pay taxes on what you take out. Now, for most of the last 3 decades, this mechanism was essentially irrelevant at the macro level. The boomers were still working, still contributing, still in the accumulation phase. The inflows dwarfed the outflows. The demographic wind was at the market's back. That wind is about to change direction. Here is the math that keeps institutional strategists up at night. Right now, the total annual inflows into US retirement accounts, the 401k contributions, the IRA deposits, all of it, run at approximately one level, and the total RMD outflows, while growing, are still running below that level. The market is still in net accumulation mode. Demographically speaking, 2028 is the flip year. That is the year, based on current actuarial projections and the age distribution of the boomer cohort, when the math inverts. When the amount of money legally required to leave retirement accounts will, for the first time in the history of the modern financial system, exceed the amount of new money flowing in. The structural bid becomes a structural ask. And understand what that means in practice. It doesn't mean a sudden crash on a specific date. Demographics don't work like an earnings miss. They work like a tide, slow, relentless, and operating entirely independent of sentiment, Fed policy, or corporate earnings. The RMD seller does not care about your technical analysis. They do not care about the 200-day moving average. They have a tax deadline and a government mandate, and they are going to sell. Now multiply that individual seller by the tens of millions of boomers who will be in RMD territory between 2026 and 2035. And remember that they own 30% of the market. There is something else worth stating clearly here. This is not a prediction. It is not a model built on assumptions about interest rates or geopolitics or presidential policy. It is arithmetic. It is the inevitable output of a demographic bulge moving through time. The boomers saved into the market for 40 years because the system was designed to make them do exactly that. Now the same system, with the same legal force, the same mandatory structure, is going to make them take it out. Gear 1 put the money in by law. Gear 3 takes it out by law. And the window between those two mandates, that 34-year window, is what the entire modern bull market was built inside of. We are now at the far edge of that window. 2028 is not a prediction. It is a calendar date, and it is approaching at exactly the speed that time always moves. So now you understand the three gears: the mandated inflow that inflated the market by law, the corporate safety net that is being cannibalized by an AI arms race, and the demographic wall that turns the structural bid into a structural ask starting in 2028. The natural next question is the one everyone asks at this point in the analysis. Okay, if not stocks, then what? And this is where I need to slow down and be very precise with you. And because the instinct most people have, the reflex that has been trained into investors over 34 years of a specific market structure, is going to be exactly wrong in the next era. That reflex is this: when stocks fall, move to bonds. When bonds feel uncertain, move to cash. When cash feels uncertain, move to the dollar. That playbook worked beautifully for most of the last 3 decades. It was clean. It was logical. It was the foundation of every balanced portfolio, every 60-40 allocation, every target date fund sitting inside the 401k system we just spent the last 7 minutes discussing. And then came what I call the Liberation Day lesson. In April 2025, something happened that rattled even the most seasoned institutional desks. In the span of a few days following a sweeping tariff announcement, and the market didn't just reprice equities, it repriced everything. Stocks fell, bonds fell, the dollar fell simultaneously. The traditional safe havens moved in the same direction as the risk assets they were supposed to protect against. That was not an anomaly. That was a preview. What Liberation Day demonstrated, in real time with real capital, is that we have entered a regime where the correlations that defined the old playbook are breaking down. When the stress is not just financial but structural. When it involves sovereign debt credibility, currency confidence, and the unwinding of decades of artificial liquidity, the usual escapes get crowded simultaneously. Everyone heads for the exit at the same time, and the exit is smaller than anyone remembered. And bonds don't save you if the stress is about the solvency of the entity issuing them. The dollar doesn't save you if the stress is about the long-term credibility of dollar-denominated debt. In a structural unwind of the magnitude that 3 reversing gears can produce, the traditional diversification logic doesn't just underperform. It fails at the precise moment you need it most. So what does work? The answer is assets that cannot be debased. Assets that exist outside the liability chain of the financial system. Assets whose value is not contingent on the creditworthiness of a government or the earnings forecast of a corporation. Hard assets, real assets, things that were scarce before the Federal Reserve existed and will remain scarce regardless of what any central bank decides to do next. Physical commodities, productive land, and most relevantly for this conversation, gold. But here is where I need you to stay analytical and resist the emotional trade, because gold in the next cycle is not a straight line up. It is a sequence. And if you don't understand the sequence, you will either miss the entry or get shaken out before the real move. Here is the sequence as I see it mechanically. When the next major liquidity event hits, when the forced selling begins in earnest, when margin calls go out, when RMD sellers and passive fund redemptions are all hitting simultaneously. The first thing that happens is not a flight to safety. The first thing that happens is a liquidity grab. Institutions and individuals under pressure don't sell what they want to sell. They sell what they can sell. And gold, being one of the most liquid assets on the planet, gets sold. Not because anyone wants to sell it. Not because its fundamental case has changed, but because it is available, it is liquid, and the margin call doesn't care about your thesis. That dip, that counterintuitive sell-off in the one asset that should theoretically be doing well, is the entry point that most retail investors will either panic through or miss entirely. They will see gold falling during a market crisis and conclude that it isn't working, that it was overhyped, that the thesis was wrong. And then when the acute phase of the crisis passes and the policy response begins, because there will always be a policy response, there will always be more liquidity injected, more currency created to paper over the structural damage, gold will do what it has done after every major monetary expansion in the last century. It will go vertical. The post-crisis gold play is not about fear. It is about the mechanical certainty that the policy response to a structural unwind will involve the creation of significant new currency. And every dollar, every yuan, every euro created in that response is a unit of dilution against a fixed supply of a hard asset that has held value for 5,000 years. That is not sentiment. That is not a prediction. That is the documented, repeatable response of hard assets to monetary expansion. A sequence we have seen play out after 2008, after 2020, and that will play out again with even greater force when the three gears we just discussed complete their reversal. The positioning is not complicated. It is just uncomfortable. Because it requires patience through a dip that will feel like defeat before it turns into the most important trade of the decade. Stay analytical. Understand the sequence. And do not confuse the liquidity grab with the conclusion. So let me bring this full circle. Back to where we started. 77%. One man's model, one dramatic headline, and an entire financial media ecosystem built around the spectacle of a number rather than the mechanics behind it. Here is what I want you to take away from this video. Not a prediction, not a target, not a date circled on a calendar with a crash marked in red. I want you to take away a framework, because frameworks outlast predictions. Frameworks tell you why something is happening, which means they keep working even when the timing shifts, even when the headline changes, even when the next commentator comes along with a new and more frightening number. The 34-year glitch was not a miracle. It was not the natural state of markets finally asserting itself. It was not evidence that American capitalism had permanently transcended the gravitational pull of 126 years of valuation history. It was a sequence, a government mandate that turned retirement saving into a perpetual price-insensitive inflow, a corporate buyback regime that placed the largest and most cash-rich companies in history into the role of permanent buyer of last resort. And a demographic bulge, 76 million baby boomers moving through their peak earning and saving years, pumping capital into the system at a scale and consistency that had never existed before and will never exist again. 3 gears, running simultaneously. For 34 years. In the same direction. And now, for the first time, all 3 are pivoting. The passive inflow is hitting the ceiling of a fully enrolled workforce. The buyback safety net is being cannibalized by a $650 billion AI arms race. And 2028 is on the calendar, not as a prediction, but as an actuarial certainty, the year the demographic tide reverses and the mandatory outflows exceed the mandatory inflows. The math is not angry. It is not ideological. It does not care who is in the White House or what the Fed says at the next press conference. It is simply catching up, the way math always does, slowly and then all at once. That is the real conversation, not 77%, not one man's model. The conversation is about 3 structural forces that artificially elevated this market for a generation. And what happens to asset prices when all 3 reverse in the same decade? That is what you need to be thinking about. That is what you need to be positioned for. I've pinned the refinancing risk map in the comments below. Use it to identify which sectors are standing directly in the path of this mean reversion, the parts of the market most exposed when the 3 gears stop turning in their favor. It will show you where the structural pressure lands first and where the smart money is already quietly rotating away from. Study it. Use it. And if this framework gave you a clearer way to think about what is happening in this market, share it with someone who is still asking the wrong question. I'll see you in the next one.